Look at this number, 88.19 million ounces. That's all the registered silver left on COMEX. Now look at this number, 222 million ounces. That's what's owed in March contracts alone. You see the problem? China, the world's largest physical buyer, has been dark all week. Lunar New Year, silver still climbed 9% without them. Now here's what nobody's talking about. Sunday night, Shanghai reopens. What happens when a market that moved this much without the biggest player suddenly sees them walk back in? 4 trading days left before March settlement. The deficit is already 134 million ounces. And the clock is ticking. Welcome to Currency Archive, where we don't just read headlines, we read the actual vault reports. Now, if you've been watching markets long enough to remember when silver was still called poor man's gold, when a handshake meant something, and when numbers actually mattered, do me one simple favor. Hit that subscribe button, not for the algorithm, for yourself. Because what's coming, you'll want this analysis in your corner. And drop a comment. Just 2 words. Your city, your country. Let me know where you're watching from. Are you in New York, London, Dubai, Karachi? Let's see how global this audience really is. Now, let's get into what actually happened while everyone else was sleeping. The silver market closed Friday at 84.57 per ounce on the futures exchange. That number represented a 9% climb in a single week. What made this movement unusual was not the percentage, it was what did not happen during that time. China was offline, completely dark. The Lunar New Year holiday shut down the Shanghai Futures Exchange for the entire week. The world's largest physical buyer of silver sat on the sidelines while the price climbed nearly 9 full percentage points. This defied conventional market logic. When major demand centers go quiet, prices typically soften. Sellers remain. Buyers disappear. The imbalance should push prices down, not up. Yet silver moved in the opposite direction with force. The COMEX warehouse reports told a parallel story that most analysts missed entirely. Registered silver inventory, the metal actually available for physical delivery against futures contracts, sat unchanged at 88.19 million ounces going into the weekend. Not a single ounce moved in or out of registered status. The number froze. But eligible silver, the broader category of metal sitting in COMEX vaults but not immediately deliverable, continued bleeding. Another 1.2 million ounces walked out the door in the final trading session of the week. This metal simply left the system while everyone watched the price climb. The mathematics of the situation created a structural problem that could not be ignored. The March silver contract carried open interest representing approximately 222 million ounces. This was the total amount of silver theoretically owed to contract holders who might demand physical delivery. The registered inventory available to fulfill those demands stood at 88 million ounces. The deficit calculated to 134 million ounces. That represented the gap between what existed in deliverable form and what could potentially be requested. This was not a small discrepancy. This was a structural mismatch of significant proportion. The roll process from March contracts into May contracts moved at a pace that raised questions. Only 15 million ounces rolled in a single trading day. With 4 trading days remaining before March entered its settlement period, the volume of contracts still open remained extraordinarily high. The clock was running. The roll was not accelerating. Financial media coverage focused on the price movement. Headlines celebrated the rally. Commentary discussed momentum and technical breakouts. Almost no mainstream analysis addressed the inventory situation or the China absence factor. The connection between these elements went unremarked. The business community watching these markets faced a strategic question that had no clear answer yet. If silver climbed 9% without China participating, what would happen when China returned? The Shanghai Futures Exchange would reopen Sunday evening Eastern Standard Time. That was fewer than 48 hours away from Friday's close. History provided some context, but no certainty. Previous instances when major demand centers temporarily exited markets showed mixed results. Sometimes prices consolidated, sometimes they accelerated. The difference usually came down to whether the returning buyer entered aggressively or cautiously. The current setup contained elements that made prediction difficult. Silver had already moved substantially. The inventory deficit was already established. The March contract timeline was already compressed. China would not be walking into a stable waiting market. They would be entering a market that had moved without them, that faced a delivery squeeze, and that showed no signs of fresh metal arriving to relieve the pressure. Industrial users of silver, particularly those with manufacturing operations in Asia, faced immediate procurement decisions. Wait for potential pullback after China's return, or secure supply now before possible acceleration? Neither choice carried obvious safety. The solar panel manufacturing sector alone represented enormous silver demand. China dominated global solar production. If Chinese manufacturers returned with urgent restocking needs, that demand would hit a market already showing strain in its physical delivery infrastructure. The weekend provided 48 hours of silence before the question received its answer. Sunday night would reveal whether China's absence had been a temporary relief valve or whether their return would intensify the pressure already building in the physical silver market. The numbers were public. The timeline was clear. The anomaly was undeniable. What remained uncertain was whether Tuesday's opening in Asian markets would confirm the structural concerns or dismiss them. The business community would have its answer soon. The COMEX vault system operates on a principle most market participants never examine closely. Two categories exist: registered and eligible. The distinction matters more than the terminology suggests. Registered silver carries a warrant. This warrant represents a legal claim. A futures contract holder demanding physical delivery receives metal from the registered category. The warehouse issues the warrant. The metal moves. The transaction completes. This process has functioned for decades without significant disruption. Eligible silver sits in the same physical vaults, the same security, the same storage conditions, but no warrant exists. The owner has not made this metal available for delivery against futures contracts. It remains private property stored in a COMEX facility. The metal exists. The availability does not. The past 90 days revealed a pattern that deserved serious attention. Registered inventory declined from 103 million ounces in mid-November to 88.19 million ounces by late February. That represented a 14% reduction in deliverable supply over 3 months. The eligible category fell even harder, dropping from 198 million ounces to 176 million ounces in the same period. Total COMEX silver inventory stood at 264 million ounces. 3 months earlier, that number had been 301 million ounces. The system lost 37 million ounces, while silver prices traded in a relatively narrow range. This was not panic buying. This was steady, persistent drainage. What made this situation more complex was the conversion mechanism between eligible and registered. Owners of eligible silver could convert their holdings to registered status at any time. This process required simple paperwork. The metal did not move physically. The classification changed. The warrant issued. The supply became available for delivery. This conversion had effectively stopped. The flow from eligible to registered that typically replenished deliverable supply had slowed to minimal levels. Metal owners were not making their holdings available. The implications were straightforward. Those who owned physical silver in COMEX vaults saw more value in keeping it private than in earning the storage credits and fees associated with making it deliverable. The February contract provided recent evidence of delivery behavior. Final delivery numbers showed 8.4 million ounces actually delivered against February futures. That contract had been smaller than March. The delivery percentage relative to open interest had been higher than historical norms. More contract holders than usual had demanded physical metal rather than rolling to future months or settling in cash. Industrial demand existed independent of investment speculation. Electronics manufacturing consumed silver. Photovoltaic solar cells required silver paste. Medical applications used silver compounds. These industrial users needed actual metal, not futures contracts. Their demand continued regardless of investor sentiment or price levels. Global mine production for silver ran approximately 830 million ounces annually. That number had remained relatively stable for several years. New mine development required years of lead time. Existing mines operated near capacity. Supply increases could not happen quickly, even if prices incentivized new production. Above-ground inventory drawdown rates exceeded new mine supply entering the market. This was not a temporary imbalance. The deficit had persisted for multiple quarters. The inventory that had accumulated during previous surplus years was being depleted. The cushion was shrinking. Exchange-traded products holding physical silver showed net inflows over the past quarter. These funds purchased actual metal to back their shares. That metal left the available supply pool. It sat in allocated storage, removed from the market's immediate trading inventory. Each inflow represented demand that would not be easily reversed. Lease rates for physical silver had begun showing unusual behavior. The cost to borrow physical metal for short-term delivery had increased noticeably in recent weeks. This indicated tightness in the immediate physical market. When lease rates climbed, it meant parties needing to deliver physical silver were having difficulty locating available supply at reasonable costs. The warehouse concentration added another dimension to the analysis. Approximately 60% of registered COMEX silver sat in just 3 warehouse locations. Geographic concentration created potential logistical constraints. If delivery demand surged, the physical movement of metal from specific locations could create bottlenecks that spreadsheets did not capture. Businesses with direct silver exposure in their supply chains faced a mathematical reality. The inventory available for immediate industrial procurement was smaller than official statistics suggested. COMEX registered inventory served futures market delivery. Industrial users typically sourced from different channels, but the markets interconnected. Tightness in one area transmitted to others through arbitrage and pricing mechanisms. The equation was simple in concept, but complex in implication. Demand exceeded supply, inventory declined, prices rose. These were market fundamentals in their purest form. What made the current situation noteworthy was the magnitude of the imbalance and the compressed timeline before March settlement would test the system's ability to deliver physical metal against paper promises. The numbers were available to anyone willing to examine the daily warehouse reports. The trend was unmistakable to anyone tracking the data over time. The question was not whether the inventory situation created risk. The question was when that risk would convert into price discovery that reflected physical reality rather than paper trading assumptions. Shanghai operates in a different time zone than New York. When Sunday evening arrives on the east coast of the United States, Monday morning has already begun in China. The Shanghai Futures Exchange opens while most American traders sleep. This timing gap creates a window where price discovery happens without Western participation. China consumes approximately 6,200 metric tons of silver annually for industrial purposes alone. That number translates to roughly 199 million ounces. To put this in perspective, total global mine production sits around 830 million ounces per year. China absorbs nearly 1/4 of all newly mined silver before it reaches any other market. The solar panel manufacturing sector drives a substantial portion of this demand. Photovoltaic cells require silver paste for electrical conductivity. Chinese manufacturers produce over 80% of the world's solar panels. Each panel contains between 10 to 20 grams of silver, depending on efficiency ratings and technology generation. The scale of production means China's solar sector alone consumes roughly 3,800 metric tons of silver annually. This demand is not optional. It is not price sensitive in the traditional sense. Manufacturers cannot simply substitute another material without redesigning entire production processes and sacrificing efficiency. They need silver. The question becomes whether they have adequate inventory or whether they need to restock immediately after the holiday closure. The Shanghai Futures Exchange held approximately 1,100 metric tons of silver in its warehouses before the Lunar New Year holiday began. Historical patterns showed this inventory level as below average compared to the past 3 years. Chinese domestic supplies were already tighter than normal before the market went dark for a week. The premium or discount between Shanghai silver prices and London spot prices reveals supply and demand dynamics within China. When Shanghai trades at a premium, it signals strong domestic demand and insufficient local supply. When it trades at a discount, it indicates adequate inventory and weaker buying interest. In the weeks leading up to the Lunar New Year, Shanghai had been trading at a premium ranging between $0.40 and $0.80 per ounce above London spot. That premium was higher than the typical range of $0.10 to $0.30. The elevated premium indicated Chinese buyers were already competing aggressively for available metal before the holiday shutdown. The Shanghai Gold Exchange, which also facilitates physical precious metals trading, showed unusually high delivery volumes in January. Physical gold deliveries exceeded 180 metric tons in the month. Silver delivery data, while less publicized, showed similar intensity. Chinese entities were taking physical possession rather than rolling contracts or trading paper positions. The currency dimension added complexity to the analysis. The Chinese yuan had weakened against the US dollar over the past 6 months. When the yuan declines in value, dollar-denominated commodities like silver become more expensive for Chinese buyers. This typically suppresses demand. Yet Chinese physical buying had remained strong despite the unfavorable currency movement. This suggested the demand was not speculative. Industrial users and strategic buyers continued purchasing regardless of short-term currency fluctuations. They needed the metal for production or viewed it as a necessary reserve asset. Price sensitivity appeared lower than economic models would predict. The State Reserve Bureau of China operates with minimal transparency. Unlike Western central banks that publish gold holdings, Chinese strategic reserves remain largely opaque. Analysts estimate China has been accumulating strategic reserves of both gold and silver, but confirmation is difficult. Occasional leaks from provincial storage facilities suggest tonnages far larger than official statistics acknowledge. If the State Reserve Bureau had been active during the months before the holiday, their absence for a full week would represent a significant gap in global buying pressure. Their return could coincide with other industrial and commercial buyers, creating a concentration of demand hitting the market simultaneously. Cross-border arbitrage mechanisms between Shanghai and London normally keep prices aligned within narrow bands. When Shanghai trades at a sufficient premium, metal flows from London to Shanghai to capture the profit. When London offers better prices, the flow reverses. These arbitrage trades require physical movement of metal, logistics, coordination, and time. The current profitability of shipping silver from London to Shanghai exceeded normal levels. The premium was high enough to justify the transportation costs, insurance, and time delays. This indicated metal would likely flow toward China once markets reopened. That flow would reduce available inventory in Western markets at precisely the moment COMEX faced its March contract settlement pressure. Historical post-holiday trading patterns showed first-day volumes typically running 30% to 50% above normal daily averages. Buyers and sellers who had been unable to transact for a week compressed their activity into the reopening session. If this pattern held, Monday's Shanghai trading would see intense volume as participants repositioned. For businesses operating supply chains dependent on Asian manufacturing, the reopening presented immediate strategic questions. Would Chinese restocking drive prices higher in the short term? Would Western suppliers face competing bids from Asian buyers? Would delivery timelines extend as available metal concentrated in Chinese hands? The solar sector build-out continued accelerating under government mandates throughout Asia. India, Japan, and Southeast Asian nations joined China in expanding renewable energy infrastructure. Silver demand from photovoltaic manufacturing was not a cyclical factor. It was structural and growing. Sunday night would begin answering questions that had accumulated during the week-long silence. The intensity of Chinese buying, the depth of available supply, the willingness of current holders to sell at prevailing prices. These factors would emerge in real time as Shanghai trading resumed. The global silver market was about to discover whether China's absence had been holding back a wave of demand or whether the price rise during their holiday would discourage aggressive buying. Within 12 hours of Sunday evening, the first signals would appear. The business community would be watching. The timeline compressed into a sequence of events that would unfold with mechanical precision. Sunday evening at 6:00 p.m. Eastern Standard Time marked the Shanghai Futures Exchange reopening. That was approximately 7 a.m. Monday morning in China. The first trades would print. The first bids would hit the market. The week-long silence would end. 12 hours later, COMEX electronic trading would begin in New York. By then, the Asian session would have established a price direction. Western traders would respond to what had already occurred while they slept. The global silver market would reconnect after operating in separate time zones for 7 days. March contract first notice day arrived on Wednesday, February 26th. That was the deadline when contract holders had to declare their intention to take physical delivery or roll into future months. After that date, the delivery process became legally binding. Sellers had to produce metal. Buyers had to accept it or pay penalties for refusal. 4 trading days separated Friday's close from that critical Wednesday deadline. Monday through Thursday represented the window when the majority of position adjustments had to occur. Rolling 222 million ounces of open interest into May or July contracts required enormous volume. The execution of that roll would reveal whether participants believed physical delivery was viable or whether they were avoiding the settlement process entirely. Historical data on March contract settlement weeks showed average daily volatility of 3.2% during the 5 days preceding first notice. That was roughly double the normal daily volatility for silver. The combination of position squaring, delivery decisions, and options expiration created price swings that exceeded typical trading ranges. The current March open interest of 222 million ounces compared to registered inventory of 88 million ounces created a coverage ratio of 2.5 to 1. For every ounce of deliverable silver, 2.5 ounces were theoretically owed. Coverage ratios in this range had occurred before, but rarely with inventory levels this low in absolute terms, and rarely with such limited eligible inventory available for potential conversion. Short positions in the silver market faced particular pressure under these conditions. The commitment of traders report from the previous week showed commercial traders holding net short positions equivalent to approximately 95 million ounces. These were typically industrial users, mining companies and banks hedging physical exposure. Their short positions were often backed by physical metal or production, but a portion of the short interest came from speculators betting on price declines. Those positions were not backed by physical metal. If delivery demands exceeded expectations, these shorts would need to either purchase contracts to close their positions or acquire physical metal for delivery. Both actions would push prices higher. Options. Expiration added another layer of complexity. Silver options with strike prices ranging from $80 to $90 carried significant open interest. These options expired on Tuesday, February 25th, 1 day before March first notice. The delta hedging activity from options dealers as expiration approached could amplify price movements in either direction, depending on where the market traded, relative to major strike prices. The regulatory framework provided some constraints, but left substantial room for market stress. COMEX position limits restricted any single entity from holding more than 6,000 contracts in the spot month, once first notice arrived. That limit equaled 30 million ounces. The limit was designed to prevent market manipulation, but it also meant that even within regulatory boundaries, concentrated positions could exist that significantly exceeded available registered inventory. Enforcement of these limits occurred through daily reporting and post-trade surveillance. Real-time intervention was rare. If violations occurred, they were typically identified and addressed after the fact. The settlement process itself would reveal whether any entities had exceeded limits or engaged in behavior regulators deemed problematic. Scenario modeling based on current data suggested 3 potential outcomes for the week ahead. The first scenario involved orderly roll activity with minimal delivery requests. March open interest would decline rapidly as positions moved to May or July. Prices would consolidate or decline modestly as the settlement pressure dissipated. This was the outcome market structure assumed would occur. The second scenario involved moderate delivery demand combined with aggressive Chinese restocking. March open interest would decline more slowly than normal. Actual delivery requests could reach 15 to 20 million ounces. Prices would rise as physical tightness became apparent, but would not spiral into extreme moves. This outcome would stress the system without breaking it. The third scenario involved high delivery demand coinciding with strong Chinese buying and limited rolling activity. Delivery requests could exceed 25 million ounces. The gap between registered inventory and delivery obligations would become undeniable. Prices would spike as the market recognized that paper contracts significantly exceeded physical availability. This outcome would represent a structural failure in the future's delivery mechanism. The copper and silver markets showed increasing correlation over the past month. Both metals faced supply constraints. Both had industrial demand profiles. Copper had been trading near multi-year highs. If copper continued strengthening, it would provide fundamental support for silver beyond the inventory dynamics. The base metals complex was signaling broader concerns about physical commodity availability. The Federal Reserve had a policy meeting scheduled for March 18th and 19th. While 3 weeks away, forward guidance and positioning ahead of that meeting influenced commodity markets. If expectations shifted toward prolonged higher interest rates, it would typically pressure precious metals. But if inflation concerns resurfaced due to commodity tightness, it could support metals despite rate policy. The interplay between these factors remained uncertain. For business leaders managing organizations with silver exposure, 3 concrete actions warranted consideration for the week ahead. First, verify current inventory levels and assess coverage for the next 90 days of operations. Second, review hedging strategies and determine whether existing contracts provided adequate protection given the possibility of price volatility. Third, establish communication channels with suppliers to understand their delivery capabilities under stressed market conditions. The convergence of these elements, China's return, March settlement, inventory constraints, and compressed timelines, created conditions where small changes in behavior could produce outsized market reactions. The market had moved 9% without China. Settlement pressure existed regardless of Chinese participation. The inventory deficit was mathematical fact, not speculation. Sunday evening would begin revealing whether these structural factors would translate into price discovery that reflected physical scarcity, or whether the system would absorb the pressure through mechanisms not yet visible in the data. The business community had 4 trading days to observe, adapt, and position accordingly. The clock that had been ticking throughout the Chinese holiday was about to become significantly louder.